Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximises value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximises personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena, I would like to talk about medical specialists becoming self-employed. So really transitioning from a PAYG role into obviously a self-employed role, and appreciate that that doesn't happen overnight and it can be a transitional period. And also a lot of medical practitioners might continue to earn both forms of income, some PAYG, some public work, and then obviously your private practice work. And there's a lot of noise out there in terms of how to structure that, particularly around how to save taxes and so forth. Some of it is misguided. And also you need to think about then also how do you protect your assets? How does your business income structure then help you build wealth tax effectively, and all the subsequent decisions that come along with that. So let's jump into it, mate. Let's talk about structure.
Sounds good. So more often than not, a medical practitioner is most likely going to be structured as a sole trader. And as Stuart mentioned, there's a lot of noise out there that will talk about why you should be in a corporate or trust structure for basically two main reasons. And that's really asset protection and tax minimisation is what they quote. So I thought we would sort of go into those two pain points in more detail and explain why we still recommend a sole trader structure when operating or trading as a medical practitioner. So I'll start off on the asset protection front. So when you become self-employed, you're going to have professional indemnity insurance, and that will basically cover you in all instances except for that of criminal negligence. And even when there's criminal negligence involved, sometimes the corporate veil can be lifted if you are trading in a company, and they can still go after you individually as well. So from that perspective, a corporate structure is not going to really provide any additional asset protection when you're trading as a medical practitioner. Now, there's certain things that you can do to basically improve your position from an asset protection perspective, and that's things such as putting the family home in your partner's name or investing within a company or trust structure, so just to protect your personal assets. Now, again, we don't believe that's necessarily a risk as such, but a small step just to take that extra precaution is not a big deal. Now, the second thing is tax minimisation. Now, you might recall from previous podcasts where we talk about personal services income. Now, what that basically means is that the income that a medical practitioner derives as a sole trader is basically derived as a result of their direct expertise, their knowledge, and without them, basically, there would be no business. So what the ATO then wants is that all the income to be streamed to the medical practitioner individually. So by having a company or trust structure, it's not going to allow you to stream income to different beneficiaries. It's not going to allow you to basically retain profits within a company. However, there are avenues to minimise your taxes as a sole trader, such as, for example, employing your partner if they're doing, for example, bookkeeping or admin-based services for you, appointment and record keeping and so forth. And then, of course, you can top up their super. And then you could also consider using equity in your property to pay for certain business expenses and converting that sort of non-tax deductible debt into deductible debt.
So let's talk about building wealth, because ultimately, as holistic accountants, that's what we think one of our key jobs is to do, is to help clients ultimately improve their personal financial position. And of course, one way we can do that is help them minimise tax and protect assets, as Mena has talked about. But then, one of the reasons that we get out of bed and go to work in the morning is that, we ultimately want to put that money that we earn to good use, invest it for the future so that we've got a sound financial position and choices later on in life. And so as holistic accountants, we need to think a little bit broader than just, okay, how are we going to deal with your tax this year, and let's make sure your business structure is protecting your other assets. So there's lots of things that we can talk about, of course, with respect to building wealth for medical practitioners, but we just want to touch on some of the common factors that we sort of come across, or issues that clients come across, of course. And the first one I'd like to talk about is super contributions. So, of course, if you're in private practice, you don't necessarily have to make super contributions. And unfortunately, some people take that very literally and completely ignore superannuation. The problem with doing that is because we have superannuation contribution caps, the longer you do that for, as in ignore superannuation, the bigger the compounding problem, because it's then a lot harder to sort of catch up or make catch-up contributions and get more money inside super. So if you're in a situation where, your cash flow is pretty tight, a lot of medical practitioners, when they first start public practice, they've got a large home loan, for instance, maybe kids in school, all these sorts of things, and they think, look, it's not a priority at the moment to put money in super. So we're not suggesting that everyone in every situation needs to maximise their concessional contributions, but I think making zero contributions is pretty extreme as well. So at least some contributions. Also, it's quite possible if you've just become self-employed, you've just joined private practice, that it's possible that you might not have utilised caps in past years. And we tend to see practitioners' incomes increase significantly in the first couple of years, particularly in the first couple of years of private practice. So sometimes going back, if your super balance is less than 500,000, going back and making up those catch-up contributions, you can go back 5 years. It's a sort of one-off sort of free kick, if you like, in terms of saving tax, but again, allows you to get more money inside super, and that makes sense as well. Spousal contributions, as well as making contributions on behalf of your spouse, as in concessional contributions, and having some sort of employment relationship with your spouse as well, if they can genuinely undertake some activities to help you in your business, in your private practice business. You can pay them a market level salary, and then you can make super contributions on their behalf. That doesn't matter that salary plus the contributions isn't deemed market level, but it's, again, a great way to minimise your personal tax and also get some more money into super. A premises is a common sort of question that we come across with self-employed medicos. So that is, do you own your practice premises? And that could be a lot of different things. It could be rooms inside a hospital or part of a hospital, for example, or it could be a converted residential house in a location that, you can run rooms from. The first thing we think about is, does it make it otherwise great investment? Because obviously if we're going to buy an asset, we want a return. And if we buy the worst asset on the face of the earth, of course, we're not going to get a return. So that doesn't necessarily mean it's a good investment. You're better off actually just to pay rent for that asset. Now, just because it's not a great investment doesn't necessarily mean we would say no, or we would say it's not a great idea. Sometimes owning rooms, that is, having being in a specific location, having security over being in that specific location, can open you up to a better referral network. So sometimes in some situations we've gone, well, we don't think it's a great investment, but we understand there's some wider sort of benefits of being in this particular location. In terms of the entities to own that in, of course, the self-managed super fund could be a really attractive entity, depending on how much money you've got in super. But one of the benefits of that is that obviously you can pay rent into the super fund, and that rent is only taxed at 15%, as opposed to, the different taxation consequences of being outside super. Or it could be an ungeared unit trust or some other arrangement if you don't have enough money inside super. But I think being too focused on rent money is dead money won't always lead you to the right decision with respect to owning your practice premises. You've got to think a little bit wider than that, because there's obviously an opportunity cost associated with it, whether we're dealing with a scarce resource like borrowing capacity, or whether we're using some superannuation monies as a deposit towards some rooms. There's an opportunity cost that we need to consider. And the last common situation is borrowing. So, of course, when we go through training, then we qualify, and then when we make a decision to go into private practice, you've spent a lot of years probably under-earning your peers. Your peers that even if they ended up doing a trade job, they're probably well in front in terms of earnings. So quite often we find that, and of course your income is going to be, go up like a hockey stick, so that, you'll make up for lost time. But the best way to make up with lost time is to use gearing as a strategy, whether that's to upgrade your home, because quite often we find that's one of the key considerations, and that's fine. That probably should be done earlier in the investment cycle. But also then, as a result of having a large non-tax deductible home loan, we need to think about what are the wealth building strategies that we can utilise other than or in addition to cash flow to be able to repay that debt. Well, ironically, adding more gearing to a strategy can be a good solution there. Now, whether that's into the property market, whether it's gearing into the share market, or combination of those two things is going to be different for everyone, but they're the common situations that we see. So we believe as holistic accountants you need to have that holistic plan. So how are you going to get into private practice? What tax minimisation strategies can you implement? But also, what other factors can you explore to ultimately build your family's wealth and your own personal financial position so you're in as a stronger position as possible. We hope that's been a sort of good introduction, if you like, but of course, this is information only, not advice. So if you do have any questions, don't hesitate to reach out to us. And until next week, bye for now.